Let's start off with the latest at the SEC.
Well, the implosion of Archegos has apparently prompted regulators to take a close look at how firms reveal their derivative holdings. According to people familiar with the matter, the SEC is now exploring how to provide or increase transparency for the type of derivative bets that sank Archegos so spectacularly. That's the family office of billionaire Bill Hwang, and it involved multi-billion-dollar losses for many banks as a result. Now, the review, what we're told, is in the early stages, and here's some of what we're also understanding is in focus. Public documents known as Forms 13F and 13D, they typically reveal the big stock holdings of hedge funds, mutual funds, and family offices. Investment firms that own shares worth at least $100 million have to file a 13F that shows their portfolio every quarter. Those funds issuing a 13D are required to do that after they amass a large stake exceeding 5% in any one company. Now, Archegos didn't appear to have ever filed a 13F or 13D, and as we now know, they use swaps rather than common stock and amassed a huge, almost what you could call off-book position, including an estimated $10 billion wager on Viacom CBS. Again, the blow-up of Archegos left many banks holding the bag and regulators asking significant questions. We also know the SEC is under pressure from Capitol Hill in wake of the GameStop mania, and so it appears they are moving rather swiftly on this front.
After the blow-up, there's been much focus on the head of the Prime Services Risk Unit who stepped down. Give us a little bit more insight into him and what we can expect also from their earnings later Thursday.
Yeah, well, at Credit Suisse, executives apparently had given the point salesman to Archegos Capital on its swap desk the new responsibility of instead overseeing risk-taking in the broader prime brokerage unit. Now, this is according to people close to the matter, and as we now know, those swaps bets collapsed spectacularly. They caused Credit Suisse a loss of about $4.7 billion. That's what they're now writing down. And the salesman, Parshu Shah, a 20-year veteran at the firm, had apparently nurtured the relationship with Archegos. He has stepped down in the wake of the collapse, but it certainly leaves a lot of questions. Credit Suisse has replaced a sweeping, or is engaged in a sweeping shakeup of the executives involved in any kind of risk management. At least 7 have been forced to leave the bank or been replaced. And big questions are left in the wake about little-known areas of risk control. They are typically behind-the-scenes functions at any bank. We should point out it is not typical for revenue-generating employees to switch to risk oversight roles, but some banks do that. In terms of the earnings, Archegos will clearly be front and center.